Hey everyone, welcome. So today we're going to demystify a topic that I think is super important for anyone with an investment account. We're going to cover what actually protects your money if your brokerage firm goes belly up, and then what you should be doing with all that cash that's just sitting in your account. Okay, let's get into it.
All right, let's just start with the big, kind of scary question that's probably on your mind. If the company holding all of your stocks, all your investments, suddenly goes bankrupt, what happens? I mean, is your money just poof, gone? It's a really critical question for any investor to ask.
You know, we all get how banks work, right? You put your money in a savings account and boom, it's protected by the FDIC. It's simple. It's something we're taught. But when it comes to your investments, who's got your back then? For a lot of people, it's this big question mark. And the answer, well, it's probably not who you think.
And let's be crystal clear about one thing right off the bat. Your brokerage account is absolutely not FDIC insured. That's a common mix-up. That protection is strictly for banks. For your investments, there's a whole different player, a completely different system in place.
So, if it's not the FDIC, then who is it? Well, it's time to meet the key player in all of this, the SIPC.
You know, to really get why the SIPC is such a big deal, you have to rewind the clock a little. Before 1970, if your broker went under, you were pretty much on your own. There was basically no protection. It was a massive risk. So that all changed when Congress finally stepped in and created the SIPC.
So what is this thing? Well, the Securities Investor Protection Corporation, SIPC for short, has a very specific mission. It's there to protect you, the investor, against losing your cash and securities if your brokerage firm becomes insolvent. Think of it as a safety net, specifically for the failure of the firm itself.
So, let's talk numbers. How much are we actually covered for? The SIPC protects you for up to $500,000 total per account. But, and this is the part you really need to pay attention to, within that $500,000 limit, there's a separate cap of $250,000 specifically for cash. This is a super important distinction to remember.
Okay, let's make this real with an example. Let's say you have $300,000 in cash and $150,000 in stocks sitting in your account when your firm fails. The SIPC steps in. They're going to restore the full $150,000 of your securities, no problem. But for the cash, they'll only restore $250,000 because that's the maximum. So you get back $400,000 in total. That extra $50,000 in cash, yeah, unfortunately, that's not covered.
All right, this brings us to what might be the most crucial part of this whole explainer. Understanding what the SIPC does is one thing, but knowing what it doesn't do is absolutely essential for protecting yourself.
Okay, this list is so important. The SIPC is not going to bail you out if your favorite stock tanks or if you make a bad investment. It doesn't cover market losses, it doesn't cover fraud or just plain bad advice. It also doesn't cover specific things like commodities or unregistered securities. Its only job is to make you whole if your firm fails, not to protect you from the actual risks of investing.
And you know, there's a quote from our source material that just nails this point perfectly. It says, "The element of risk is inherent to investing, which is why investments cannot be insured." And that's really the bottom line. Investing has risk. That's the whole game. SIPC isn't there to take away that risk. It's just there to make sure the assets you legally own are returned to you if your broker vanishes. So you might be asking, well, if SIPC doesn't cover fraud, who does? And that's a great question. For issues like that, or misconduct, you turn to the big regulatory bodies, like the SEC or FINRA. They're the ones who enforce the rules and go after bad actors.
Okay, so now that we know the rules of the game, let's talk strategy. What can you actually do right now to make sure you're protected?
First things first, this protection only works if your firm is actually a member. So step one, and don't just assume this, is to confirm your brokerage is an SIPC member. Step two, sometimes firms use other companies to handle transactions, so check if any of those third-party firms are members too. And step three, if you have any doubt at all, just call the SIPC directly. Seriously, they'll tell you.
Now listen up, because this is a really important warning. A big challenge for the SIPC is telling the difference between a bad investment that you made and a loss that happened because of some shady, unauthorized trading. If you want to make a claim for that kind of activity, the burden of proof is probably going to be on you.
So what's the big takeaway here? You need documentation. You need a paper trail. If you even suspect something funky is going on in your account, don't just pick up the phone. Send a formal letter, send an email to your firm right away. This creates a record, a paper trail, that could be absolutely priceless down the line if you ever need to prove your case. And here's another pro tip that a lot of people miss. Many brokerage firms offer something called excess SIPC insurance. It's basically extra protection they buy from private insurance companies. This coverage kicks in where the standard SIPC limits leave off, and it can sometimes go into the tens of millions of dollars. Definitely ask your firm if they have it.
All right, so we've covered the protection side of things pretty thoroughly. Now let's switch gears and talk about the second part of our topic today. What in the world should you be doing with that uninvested cash that's just sitting there? You ever look at your account and see two different cash balances and wonder, wait, what's the difference? Well, you'll often see brokerage cash, which is kind of the top line total that includes money from trades that haven't settled yet, and then you'll see buying power. That's the bottom line number. That's the money that's actually cleared and ready for you to use right this second.
So once you know your actual available cash, you've got a few choices. You could, of course, reinvest it. You could park it in something relatively safe like short-term bonds, or you could just withdraw it. But a lot of firms also have a really neat feature where they'll automatically sweep that cash into an FDIC-insured bank account. This is a fantastic way to protect any cash you have that's over that $250,000 SIPC limit.
So, if you remember just one single thing from this entire explainer, please let it be this. The SIPC is there to protect your investments from your firm failing. It is not there to protect your investments from market risk. That part, managing the ups and downs of the market, that is and always will be on you.
And that really brings us to our final thought. This isn't just about knowing you're protected, it's about being proactive. Now that you understand the safety nets and the rules, the real question is, how are you going to put your money, especially that uninvested cash, to work smarter and safer for you? Something to think about. Thanks for tuning in.